Hello everyone, I'm back. Thanks for checking out my video. The US market rallied last Friday as Fed Chair Jerome Powell opened the door to a September rate cut during his highly anticipated speech at Jackson Hole. The Dow Jones Index surged to a fresh all-time high, while the S&P 500 and Nasdaq are now just shy of their own record highs. In fact, the S&P 500 posted its best single day since May this year, snapping a 5-day losing streak. Mega-cap tech stocks were among the biggest winners. Tesla soared about 6%, Alphabet and Amazon each rallied more than 3%, Meta jumped over 2%, and Nvidia gained about 1.7%. With Powell signaling that rate cuts could be around the corner and major stocks roaring back, the big question is this just a short-term pop or the start of a renewed market strength? And let's not forget, Nvidia's earnings and forward guidance are on deck this coming week, which could play a big role in shaping where this rally goes next. So without further ado, let's break it all down in this video. The stock market struggled for much of last week, with the Nasdaq and growth stocks under pressure. But on Friday, everything turned around, all thanks to Federal Reserve Chair Jerome Powell's speech at Jackson Hole. For those who are unfamiliar, the Jackson Hole Conference is one of the most important events in the world of central banking, often setting the tone for the rest of the year, and this year's backdrop was a bit unique. That's because Powell's speech marked his final Jackson Hole appearance as Fed Chair, and this came at a time when he faced relentless criticism from President Trump, therefore making Powell's words even more closely watched. Despite that political pressure, most investors had expected Powell to stay cautious and probably avoid dropping any hints on rate cut, but instead, Powell's speech came out dovish. He highlighted the softening labor market and suggested that the Fed may need to adjust its stance by saying that the baseline outlook and the shifting balance of risk may warrant adjusting our policy stance. So, as mentioned, the Wall Street had braced for a cautious Powell. Therefore, the signal that rate cuts could be on the table caught the market and investors by surprise. According to the CME Fed Watch tool, expectations for a September 25 basis points cut jumped to 83%, up from about 75% earlier in the week. My personal view is that Friday's rally was kind of a game changer, both technically and fundamentally. Major indexes and leading stocks rebounded off key levels, and many are pushing to new record highs. More on that in the technical analysis and end thoughts segments later. Alright, moving on to the final week of August, we have quite a number of Fed officials speaking in the week ahead. I think the market would love it if these speakers echo after what Jerome Powell had shared last week. During the midweek, or to be exact, 27 August Wednesday, Nvidia will report its earnings after the market closes. Their results can be quite pivotal. As the foundation of the whole AI boom and part of the Magnificent Seven, strong performance and guidance could reinforce bullish momentum in both the AI world and the stock market. But of course, without me saying, any disappointment could put lots of pressure on the market, much like the tech sector sell-off we saw early last week. So hold your breath when Jensen Huang takes the stage to share Nvidia's outlook. Another key event to watch next week is the release of PCE Price Index, the so-called Fed's preferred inflation gauge. Scheduled to be out on Friday 29 August, this data will give investors a clearer picture of how inflation is trending and whether the Fed is really on track to begin cutting rates as early as September. A cooler reading would definitely reinforce Jerome Powell's dovish tone and further fuel the market rally, while on the flip side, a hotter print might raise some doubts and add volatility, especially with stocks already sitting near record highs, but I don't think it will crash or tank the market. Okay, moving over to the technical analysis section. Actually, there's nothing much to analyze. At this point, it seems like every dip has been bought up by the dip crowd. In the video that I posted 2 weeks ago, I shared that a close above 640 for SPY means more record highs will be made in the process, because at the so-called uncharted territory, sellers tend to dry up and FOMO investors tend to step in, which then push the price higher. And that was what exactly happened as SPY sits at 640's range now. I would say this theory would apply in the coming week. another few all-time highs in the high 640s range would propel SPY higher to finally hit 650, which means the SPX could reach the milestone of 6,500, which many investors are anticipating. But if somehow and somewhat the market decides to have a mini sell-off, maybe due to poor results or guidance from Nvidia, just watch out for 629 as the first support level. I think it's quite unlikely for this level to break this week though. At the moment, every time the market dips, investors are so quick to step in and snap up the shares. So for a major pullback to happen in the next few weeks, it would likely take some big, unexpected and unknown negative event. And since it's called unknown, nobody can predict what it will be or when it will happen, so don't place too much hope on timing it. If it doesn't come, enjoy the upside. If it does, be ready to scoop up more shares. As simple as that. Moving over to Apple. Apple displayed a classic huge breakout after months of consolidation. The chart looks pretty interesting now. Okay, let's break down the details. First of all, after that breakout, it needs to take a break. So as you can see, it went near this resistance level at around 236 and got rejected. Since then, it has retraced a fair bit, but still in a healthy range. Just to highlight, the MACD is about to have a bearish cross. If it happens this week, then we can expect Apple to continue to pull back to maybe the 200 moving average level at around 220. That's also where the first Fibonacci support level is. Okay, here's where I think it's interesting. There could be a potential bull flag forming. Note the word potential, which means it's not confirmed yet. So the ideal scenario for the bulls is that Apple has a MACD bearish cross, continues its retracement, then bounces off the 200 moving average, and then break out of the bull flag. When that happens, it's super bullish. And here's my potential plan. Again, note the word potential means it's not confirmed yet, okay? And obviously, this is not financial advice, alright? So my plan is, if Apple pulls back to near the 200 moving average, I might step in to sell a put option in anticipation of a potential bounce. Okay, just some words of caution, and that will be I could be wrong, which means if Apple doesn't bounce off the 200 moving average or the Fibonacci support level, the bearish thesis will kick in. That's when I think the odds of it sliding further down to fill that gap between 215 and 216 would be high. Personally, I think if we don't have massive negative macro event, I do think the gap area or the purple line of 214 should hold up for Apple. Moving on, let's check out Tesla, which looks a little tricky to me. Let me explain. Prior to last Friday, the chart printed 7 red candlesticks out of 8, and the share price fell from 340 to 320. In the process, it lost key support levels such as the blue downtrend line and both the 50 and 200 moving averages. In addition, the MACD had a bearish crossover. All these are bearish signals. But then came last Friday and Jerome Powell, a signal that a rate cut is coming pushed the share price high up because Tesla would benefit from a lower interest rate environment. And suddenly, Tesla jumped 20 points in one day and was back to where it was at 340. This makes it tricky to tell whether Tesla is bullish or bearish right now. So what to watch next? Let's talk about the bullish thesis first. Watch that 3 support levels that I have just mentioned, the 50 and 200 moving averages as well as the blue downtrend line. If Tesla can stay above them for a few more days, especially the blue downtrend line, then the trend is leaning bullish. Pay very special attention to 349 level. That's the intraday high that was created when Tesla broke above this downtrend line. If Tesla can close above this 349 level, I think we could easily see Tesla going to high 350s or touch 360. 2 more interesting things to highlight for the bulls. Remember earlier on I said that the MACD had a bearish cross? Well, within one day it crossed back up to the bullish side again. Not just that, it looks like we have a mini bull flag forming. This may not look like a textbook version kind of bull flag, but still, I will watch it quite closely. If Tesla closes above this ugly looking bull flag for a few more days, then hitting high 350s is very likely. Before I move on to the bearish thesis, just wanted to show you how you can support this channel. I will not take up too much of your time here, so feel free to pause the video to go through the details to see which form of support suits you. Thank you in advance. Alright, in terms of the bearish thesis, the blue downtrend line and the 200 moving averages are pretty crucial. If Tesla falls below the downtrend line, it means the recent breakout was a false breakout. From here, if it further loses the 200 moving average and don't reclaim it as quickly as last week, it could spell trouble. That's when I would expect Tesla to fall to low 320 or below. But at the end of the day, so long as Tesla stays above the psychological 300 level, I think there is nothing to be worried about. It's not that bearish actually. Moving over to Google. Wow, Google looks unstoppable, which was why I saw a new put option recently, which is a bullish move. More on that in the options trading section. Anyway, Google has been hugging the top end of this purple uptrend channel. Each time it retraced, it only hit the middle channel and buyers quickly stepped in to drive the price back up. Really quite amazing. So for the bullish thesis, it's quite straightforward. If you notice, Google hasn't closed above the uptrend channel yet. Therefore, if it starts doing so, it's called a breakout. And when that happens, coupled that with the price at all-time high now, I would say the sky is the limit, which means expect multiple all-time highs. On the flip side, if Google gets rejected at the top end of the channel again, the first support level is at around 201, which the share price has rebounded off a few times recently. If that breaks, then the next support is at 198. Watch this 198 level very closely, because if Google falls below this level, I would think the probability of the share price falling further to the bottom of the channel is pretty high. In case you're not aware, the market is waiting for this DOJ ruling on its search monopoly case. What I understand is that it should be out in the next 1 or 2 weeks. The ruling would likely be the catalyst that determines whether Google hit the bottom of the channel or a clear breakout above the channel. So be very careful if you intend to trade Google this week. Moving over to Meta. Meta is pulling back after hitting multiple record highs. Currently, it seems to have found some support at 729, which is formed by the 50 moving average and 38.2 Fibonacci level. We can call this a double support level, and I would say watch it closely. If this level breaks, there is a high chance for Meta to fill the post-earnings gap up. In fact, it actually filled half of it already, and the remaining gap is between 708 and 731. In particular, pay attention to 708 because it is another double support level formed by the bottom of the gap and the pivotal 50% Fibonacci level. If this level breaks, then the trend for Meta is bearish. In terms of the upside, 2 levels or areas to watch. First is the 23.6 Fibonacci level at 755. If we can reclaim and closes above this level, that's the first positive sign. The second area to watch is the little gap down ranges from 775 to 780. If Meta can complete the gap fill and not get rejected, the probability of it pushing towards the record high again is pretty high. And at record high, you know the drill. Don't need to chase, FOMO buyers will step in and more all-time highs will likely be on the card. That means we could see the big 800 level. Okay, moving over to check out Microsoft's chart. Microsoft seems to be the future version of Meta, or like a prediction of Meta's movement. It basically had a post-earnings gap up, hit record high, retraced and filled the gap. Let's see if Meta will follow the same path. Anyway, Microsoft did not bounce up after filling the gap, so that's a little bearish, and 16 red candlesticks in the last 20 trading days. I guess that says a lot about its current trend right now. Okay, for this week, watch the 50 moving average closely. This level is around 505 and it is roughly where the 38.2 Fibonacci level sits as well. If this level gets breached, I do see more downside and continuation of the bearish trend. That's when I would expect Microsoft to go near the pivotal 50% Fibonacci level at around 489. If we do hit low 490, that would mean a slightly more than 10% discount off the peak of 554. Is it worth taking some actions here? I will leave it to you to decide. Anyway, this 489-490 level is pretty important. It has to hold, otherwise it will unlock more downside. As for the bullish thesis, the bulls would want to see the share price bounce off the current level where the 50 moving average is. A bounce off this important moving average is always positive. But I think, for me, I would want to see Microsoft reclaiming the first Fibonacci level at 524, then I would say that the short-term trend is potentially reversing. Let's now move over to Nvidia. It's a massive week for the share price as the company reports earnings on Wednesday 27 August. Lots of expectation for the company. Okay, post earnings, I think we all can expect to see huge movement in the share price. In terms of the upside, straightforward. A break above the all-time high of 184.48 would mean more record highs in the making. But that being said, let's go back to Microsoft and Meta charts. Both had a huge post-earnings gap up, and look at what happened next. They both pulled back. So if Nvidia has a post-earnings bullish gap up, I would expect the bullish momentum to continue a little bit more before it retraces back. So if you're a short-term trader and are able to trade this retracement pattern, you could profit from it. But the caveat is, this pattern is not guaranteed, and of course, you will need to set stop loss in case Nvidia goes to the moon and does not come back down. Okay, on the other hand, disappointing earnings or guidance would see Nvidia testing the 50 moving average at least. This level is at 167, that means a minimum 5% drop from the current price. This is also where the 38.2 Fibonacci level sits. From here, if this double support level breaks, I think we could head towards the pivotal 50% Fibonacci level at around 163. In fact, I wouldn't be surprised if the share price moves below this 163 level during intraday towards the 150s range. And just to add, if Nvidia starts closing in the 150s range, not just during intraday, then it's pretty bearish. But ironically, that would get me excited because that's a good area for me to consider taking actions, for example, selling a put option. Not financial advice, okay? Let's now check out my options trade. 4 trades to update this week, and they are all summarized on the screen. Okay, here's the first one, a new cash secure put on Tesla that was sold on 14 August Thursday. The strike price is $265 and the contract will expire on 26 September. This trade is a tricky one to explain, but I'm just gonna be honest. Alright, so what happened was that on 14 August, I saw Tesla was retracing after going above that blue downtrend line. Given how bullish the current overall market is, I was of the view that Tesla will find support at either the trend line or the 200 moving average. In short, I was expecting a bounce soon. But well, I was kind of wrong as Tesla did not bounce immediately. In fact, it even went below both the trend line and the 200 moving average in the next few days. However, last Friday, fortunate or not, Powell came out to save the day. His speech at Jackson Hole drove the entire market upward, including Tesla. And as a result, Tesla reclaimed both the trend line and the moving average, and my trade is now sitting on paper gain. Next up is this new cash secure put on Google that was sold on 18 August Monday. The strike price is $185 and the contract will also expire on 26 September. The rationale behind making this trade is pretty much similar to the earlier Tesla's trade. Basically, I saw that Google was on this very bullish uptrend and it has found decent support at around 201 level. Hence, I stepped in on 18 August when it was falling a little as I was expecting some bounce at the 201 level. Well, Google didn't bounce as immediately as I thought it would as the share price went below 201 for the next few days. But as mentioned last Friday, the whole market was so bullish that almost every major stock was rising, and that includes Google. With the share price rising and reclaiming 201 level, this trade is also sitting on paper gain. Alright, the third trade to update is this cash secure put on Tesla that expired on 15 August Friday. The contract was sold on 3rd July with a strike price of $235. For the thought process behind this trade, you can check out the video linked at the top right hand corner. Meanwhile, just wanted to highlight that after selling this put option, Tesla plunged the next trading day after Elon Musk said he plans to launch a new US political party. At one point, my trade was down 100%. However, here's the beauty of selling options. Time is on your side. The share price has time to recover. And as you can see, despite Tesla's volatility and zigzag price movements after the drop, it managed to recover from that slump and close way above my $235 strike price on expiration date. As a result, I earned about $240 from this trade, and that was a 200% swing. Okay, the final trade to update is this covered call on Google. Just a quick recap, the original strike price for this contract was $180 and I rolled it to $185 previously. So in my latest move, I have rolled the share price further up to $190 with a new expiration date of 26 September. The purpose of rolling the contract is to prevent 100 Google shares get caught away. If you would like to find out more about what rolling an option is, check out the video linked at the top. It's beginner friendly. Okay, here are some of my thoughts. I will split them into fundamental and technical aspects. First of all, let's look at the fundamentals. Jerome Powell has clearly opened the door for a 25 basis point rate cut at the September FOMC meeting, largely due to the recent cooling in the labor market. While he did note that inflation remains above the Fed's 2% target, Powell also acknowledged that a rate cut might be needed to support the labor market. And obviously this has gotten investors excited as seen from last Friday's rally. But why? Let me explain. The Fed has kept interest rates unchanged since last December. That's over 8 months of waiting. The market has been anticipating the next move, and a cut would be a big deal. Because lower rates mean cheaper borrowing costs and less incentive to keep money in the savings. In turn, this typically fuels more spending and investings by both companies and consumers, which is exactly the kind of catalyst that the market has been hungry for. All of this could help stimulate business activity and even the broader economy, creating a tailwind for the stock market. A rate cut would also push bond yields lower, making equities or the stock market relatively more attractive to investors seeking higher returns. And going back to Powell's speech, I thought he had threaded the needle quite nicely. Dovish enough to keep September cuts alive, but disciplined enough to maintain Fed credibility and objectivity amid political pressures. On the technical side of things, the Dow Jones has clinched its first record closing high of the year. It has been 177 trading days since the Dow's last closing record in December 2024. With this, it has joined S&P500 and Nasdaq in notching a record high this year. The latter two, after hitting record highs in June this year, have since extended their gains in record and uncharted territory. What does this mean? It means the market rally is broadening out. This is a very positive sign because we are starting to see some of the left behind sectors getting into a positive trend. Overall, the market seems to have found a fresh catalyst to push it forward, which is a semi-dovish Federal Reserve. The rally is broadening beyond the mega-cap companies and the Magnificent Seven, which suggests there is more strength below the surface and there may be more upside to come. Even if we get a pullback, the buy the dip crowd still looks very much alive. Personally, I wouldn't be surprised if the S&P 500 pushes towards 6,500, especially if Nvidia delivers strong earnings and guidance in the coming week. Okay, just some final words. We all can tell that the market is extremely bullish right now. The known risks, such as tariff-driven inflation, don't seem to be shaking investors. But then, it's usually the unknown shocks, the ones that no one sees them coming, that can trigger real tumble in the market. But the thing is, we will never know exactly when that day will come. To me, there's no point in trying to predict it. Think of it like the weather. You don't walk around with your umbrella open waiting for the rain. You just keep it in your bag and be prepared. In the meantime, enjoy the sunshine and the rally while it lasts. And as always, I remain cautiously bullish, especially when we are about to enter the worst month of the year, September. I will cover more of that in my next video. Meanwhile, don't forget to like and comment below to help boost the YouTube algorithm of this video. Thank you very much.